Every day, more and more advisors are realizing the critical role that indices can play in their practices. S&P Dow Jones Indices SPIVA data continues to show that indexing often works better than active management over the long term. And this dynamic is further amplified when you account for taxes. Of course, not all indices are made the same and can range in their applications. For example, factor indices are helping some advisors target a rules-based approach to active management. Hello, I'm Brent Kopp of the S&P Dow Jones Indices Wealth Management Channel team, and joining me to discuss the critical role that indices play in their practice are Dino, Efthimiou, and Niko Finnigan from Delta Wealth Advisors in Indianapolis. Dino, Niko, thanks so much for being here today.
Thanks.
I know at Delta Wealth Advisors, you guys are focused on comprehensive financial planning, and taxes play a big part of that. We recently released a new piece of research called our SPIVA after-tax scorecard. I'd love to hear your thoughts on how important tax management is to your clients and how that new SPIVA research could potentially be used to help shape some investment decisions.
Yeah, so really since the genesis of our firm, Delta Wealth Advisors, back in 2017, we wanted to differentiate ourselves on taxes. We knew that it played an important role in the decisions that we make. And so we really wanted to be able to have an in-house CPA firm so that we can, share our investment process. They know kind of how we trade, what we do, what products we use. And so, it was really important to us as fiduciaries, knowing that we can control taxes and fees, to be able to offer that expertise. And so having, the scorecard to kind of support our decisions and show kind of what we're doing with our indices, and why we're using them. And, again, goes back to our process, the fact that we're, low turnover. And so, a perfect example of kind of the tax part of this is back in back in COVID.
Yeah.
And so, as the market fell, we were able to take advantage of those losses and have secondary and tertiary options to go through for our clients. So.
Yeah, because you're able to do all that research beforehand, right? So we always say you're going to study for the test. You don't know when it's going to be. It could be a pop quiz, and COVID was a pop quiz. Mm-hmm. And so, prior to that, we hadn't really seen a global pandemic. But when you see things trading off so quickly, you have it all built out, all the rules. You're like, okay, we're going to move from this index onto this, realize those losses, carry them forward. And then in addition to it, with the in-house CPAs, you can also look at it and somebody can say, all right, here's kind of how my taxes are shaking out. It's very early in the year, but this is how it shakes out. Okay, let's do a Roth conversion. And you can do that you really can do it overnight. And so it's saving the clients ideally taxes, which means more in income and in net worth for them in the future. And so a core part of that is having an index, being rules-based, knowing what you own, because then you're not accidentally moving into something that doesn't have the same exposures that you were intending to own all along, because then you miss the rebound, right? And that's the critical part, is you don't want to be out on the market. We've seen all the studies on that. So owning an index gives you greater comfort as both an investment manager and also an advisor, so people can go and spend that time talking to the clients.
I know indices can be used in a couple different ways, right? They can be benchmarks. They can be the basis for investment products. Can you tell me kind of the way that indices play a role in your guys' practice?
Yeah, absolutely. So one of the things that we always talk about is standardize the process and customize the advice. So like what Dino was saying is when you have indices in there, a lot of people like to talk about returns. Well, we all know returns are expected, but fees and taxes are more or less guaranteed, right? And so let's talk about what we know we have to build off of. If we can keep our fees down low, that means that ideally then more returns are being headed to our client's way. And then in addition to that, with taxes, we see time and time again when we're running a financial plan that taxes are the largest expense in life. And so if that's a fact, how can I try to reduce or minimize taxes if I know that that's an expense and quite frankly it doesn't add a lot of joy in life to pay more in taxes? And so one of the things that Dino had pointed out was he said, look, if we look back to the global financial crisis and using active management, right? What was happening was that people were saying, all right, my portfolio's down 20, 30, 40%. And I got hit with a capital gains tax, right? Because the mutual fund kicked this off. So I lost money and now I owe taxes? How is that even possible, right? Well, when you have it in a model and you have it through indices, we have a little bit more control over the tax component of it. And then as well, when we have it in the model, what we can do is we can be a little bit more proactive about tax loss harvesting. So instead of having to wait until year end, we can look for opportune times throughout the year. You build out the rules, and then you can utilize technology. And what it does is we've standardized the process, and now we're spending more time with our clients, and we're also spending more time in the plan looking for opportunities. So that's kind of how we're utilizing indices within the practice on the investment management side.
Now, Dino, let's talk a little bit about factors. Are there certain factors that you gravitate toward when you're designing portfolios?
Yeah, so we have 5 risk-based portfolios that we use with our clients. They include low volatility, quality, momentum, size, and value.
Okay.
And depending on where you're at, if you're approaching a retirement, we would have more low volatility in that particular portfolio. In the accumulation phase, less low volatility, more momentum. And so we really like using these indices to create more certain outcomes, kind of knowing what we own, the rules-based approach kind of gives us confidence in making those decisions with our clients and achieving those goals.
So Niko, factor-based indices offer a unique blend of active and passive. And I know you have a unique way of explaining factors to clients, which I think is really helpful. So would you share that with us?
Yeah, one of the things that I find really interesting about our line of work is we're trying to take all the research that we've done, everything that we've learned over a number of years, and to be able to explain it to a client so they clearly understand what they own, right? Because too many times we'll sit down with the prospect and say, why do you own what you own? Do you understand how you own it? No, not necessarily. So, all right, let's just simplify everything. And so if you look at, for a lot of people, one of their largest purchases in life has been their house, right? And you say, all right, well, why did you buy that house? What is it that drew you to that specific home? They go, oh, well, we like the floor plan, or we like the layout, we like the neighborhood. And you go, okay, well, there's characteristics to the home. And that's what made it attractive. And it's the same thing about a stock. Stock doesn't just go up because it's a stock. It has characteristics that make people want to buy more of it, and the price goes up. Okay, so let's look at that and say, all right, imagine walking into a home. The first thing is you'll walk into, you may say, okay, good bones, really well-built home. All right, that's like quality, well-managed, well-operated, consistent cash flows over time. Or you may walk into it and you say, oh, look, this is a fixer-upper. This needs some work. So I know I can buy it a little bit cheaper, and I'm expecting the value to run up in price, okay? All right, that's a value home. That's value stock as well. Think about the location. There's 2 ends to that. One will be low volatility, which is like a good core neighborhood that's really strong performing over time. Not going to go up as much during the hot times, but it won't fall as much if we had a housing pullback. And the opposite side is momentum, which is really strong, an up-and-coming neighborhood, right? So what we're doing is we're saying, all right, we have these indices, and we're kind of explaining them in a certain way so that people understand, all right, yeah, that large asset that I own, I understand why I'm invested in stocks and how they operate over time. And I also understand that not all of them are going to outperform in the market every single year. That is explained on the upfront, right? It's not our expectation that's going to happen. We're going to have some yin and a yang. Traditionally, you see it with value and momentum, right? Fixer-uppers may be having their day in the sun, whereas later on, low volatility may. And so we just kind of take the time to walk them through that and say, here's the characteristics that we expect to own in stocks, and here's how we're going to put them all together to build outcomes for you and your financial plan. Because again, we're focused on the long term and being tax aware in there because the indices help with that as well.
I love it. That's awesome. Thank you guys so much for being here. I know the favorite part of my job is talking to advisors with unique ideas about financial planning. And I just want to thank you for being here and sharing your ideas with us today. It was great.
Thank you.
Thanks for having us.
If you want to learn more about our after-tax SPIVA scorecard, please visit us at spdji.com/SPIVA. You can also sign up to receive our monthly factor dashboard by visiting us at the link below. Thank you.